very often in the pace to grow and to impress the investors, founders take shortcuts. When you're investing, you don't run the company and you're an outsider.
Yeah.
Very often I recommend to our clients, and it's not taken up most times, is even post-deal, at some periodicity, you need to have some legal audits as well.
I always call basic hygiene in a company, right? The basic hygiene for me is you have regular boards where you send a clear agenda, where you send the pack a week in advance, and reporting is clear. Now you'd be amazed by how many companies don't have any of these. How many times we're pushing for this, and we're one of the lone voices at the board.
We're not willing to discuss failure. Investors want to scrub parts of history over time if they can. How can we then emerge stronger? Good morning. My name is James and I'm on the board of Thai Singapore. I've been an entrepreneur, I've been a venture capitalist, angel investor, and on the government side. It's an honor to have Vijay and Nick with me on the panel podcast today. Looking forward to having a great conversation with you on governance failures in Asian startups. How do we emerge stronger? To kick things off, why don't I have each of you introduce yourselves before we get into the action? Vijay, please.
Thank you, James, and good morning, everyone. I'm Vijay Sambamurthi. I'm the founder and managing partner of Lexygen, which is a law firm that I founded in India 19 years ago. And I'm now based for the last 3-4 years in Singapore, where I head the Singapore office of our firm. I've also been a long-standing charter member of TAI, first in Bangalore. And the day I got to Singapore, 5 days later, I became a charter member.
That's
and
great.
I'm delighted to be here on this podcast.
Thank you, Vijay. What about you, Nick?
Hey, great to be here. Nick Cator, founder and managing partner of Venturi Partners. We are a consumer growth investor. We invest in India and Southeast Asia, generally in Series B to Series D, investments ranging from 15 to 40 million. Not from the region, but have been investing in Asia and more particularly in India since 2009 and have gone through many waves and cycles and stories. And so it's great to be here today. Thanks for having us.
And given the huge attention in recent years, growing interest in LPs and growing interest in innovation technology that's translated into a lot of commercialization investments in Southeast Asia, we're now starting to see what we hope to see as exits. Yet at the back of it, I think we're also then seeing less glorious, less exciting news when it comes to fraud that peeks its ugly head as we try and get good news. Yeah. What are your thoughts about this topic? What has come across to you in some of these regions as you look at both the fraud or the non-fraud activities that frames your thinking about this topic?
So I think there's a distinction that we try and make between India and Southeast Asia, which are two regions of focus. I think India has matured a little bit more over the last 4 years from an exit perspective. If you just look at the number of IPOs last year, I think there were 94 IPOs on the main board in India. It was the largest market by IPO value in the world. And that's been pretty steady over the last 4 years. There's a lot of local capital or local savers putting into mutual funds every month. And so that's created this liquidity in the $5 trillion market cap of India's stock exchange today. And we're only about 15% are linked to foreign institutional investors. 85% is local. And so you can actually do IPOs at a relatively small scale of 500 million and still get liquidity. If you look to Southeast Asia, we're starting to see maturing, but it is not quite there yet.
No,
and if you look at the IPO story to date, it's actually not been as interesting or exciting. I think we are expecting a few great stories come out over the next 12 to 24 months. But the big difference is you need more scale in Southeast Asia to IPO, which is contradictory to the fact that India is 2 times the size of Indonesia from just a market perspective. And so it's easier for companies to get scale in India. But hopefully we're starting to see that. On the flip side, of course, we have seen a number of fraud cases or whatever, terrible stories, whether it's the Baiju of India, whether it was, 2 darlings, if you can call it like that, of Southeast Asia, with Zelingo first and more recently eFisheries.
Yes.
And so I think you're seeing that maybe the exuberance of 21, 22 caught up, but it's something that, I think as collectively as part of an ecosystem, we've got to try and, work together to make sure that we can reduce the negative stories and really try and focus on making Southeast Asia and this part of the world a more vibrant and also have more access.
What do you think, Vijay? What can we do about such situations? What are your thoughts in response to Nick as well.
I couldn't stress enough how important it is to talk about it. Not just because of all the cases that Nick is referencing. That's not the only reason I think it's an important topic to talk about, because I've been in this legal advisory space for about 28 years now. And I've been seeing this movie playing itself out every few years. It's a cycle. Like you have economic cycles, I think you have fraud cycles. It's a behavioral cycle. And, one of my favorite books is, some of you may have read it. It's called Dr. Jekyll and Mr. Hyde. Right? All of us have read it. And I think a lot of entrepreneurship and the entrepreneurial ecosystem is got a lot of that Jekyll and Hyde situation, because the same entrepreneurs who seem to be very passionate in the early days of their careers seem to somehow lose the way. And that's very fascinating for me, because I think some of the focus needs to be, to me, obviously on the law as a lawyer, but I think all of us need to think about it from a philosophical level. It's a highly relevant, topical one, and an evergreen topic that should keep getting talked about in the industry every now and then.
Thank you, Vijay. Nick, what are your thoughts about the reasons that lead to such fraud events, fraud sequence of events that chain up to become mega fraud, or even the smallest of fraud examples?
I think there's always, you've got to look at both sides, right? There's the founders, of course, who generally commit the fraud. And then there's the investors who have their role to play in letting it happen, right? And so I think on one side, on the founder side, it's probably always linked to maximizing valuation, minimizing dilution, and also potentially just to be able to get to fundraise, right? Because sometimes they're not able to fundraise, and so they just kind of show better numbers. And then once you've started down that alley, it's a slippery slope, because you can never catch up. And then also, because you're pushing for extremely high valuations, you have to be able to deliver for your investor that's just invested. And so you have to show them, great, amazing growth of 40, 50, 60, 70% year on year. Otherwise, they're going to start getting angry and actually start looking at the accounts again.
Definitely, yeah.
If you look at the other side, investors, I think, what we noticed, I wasn't on the board. I was an observer at Byju's for some time. And luckily, I think we sold out pretty much completely before everything unraveled.
Good for you.
Well, and what we saw is that because Byju was a darling, right, was the best company, that everybody wanted to be in it. What happened is that new investors were coming in at a later and later stage, which what you would expect is the governance to be improved stage after stage after stage as the valuation increases.
With more money in.
Exactly. We're actually asking for lesser and lesser terms. And so Byju could then come back to all of its existing investors and say, hey, this new guy is coming in at 3 times your valuation. Either you're out or you agree to these lesser terms. And so this was happening every 6 to 12 months. And so by the end, Byju's, when he was at the peak, had basically very little oversight, very little governance. The board was controlled by him, and reporting was, literally non-existing, right? And so I think investors actually helped fuel the issues that were created.
The FOMO.
Because it was not only, in Byju's case, it was not actually as much on financial accounting. It was much more on acquisitions, on where the capital was going into. So it was a slightly different case. And so what's happening is that for existing investors, it's really hard to push extremely hard on a founder when he's keeping delivering 2x every year. My valuation keeps, I'm now 7 times in the money, and I've got to go and push really hard on it. It's not an easy thing to do, right? No. Because the guy's going to say, hey, what are you complaining about? I've done amazing by you, right?
It's also no different in large companies where they do really well and there's no push to modernize in that sense, right?
Exactly.
Yes. Yeah.
And so I think that's one angle where for existing investors, as they get more and more into the money, their role, it's harder and harder for them to push. And then the new investors coming in who are really keen to get in know that it's not only a valuation, but it's maybe I'll ask for less right. I need to do less due diligence. I can be extremely fast because they really want to get in. Yeah. And so that's why sometimes it makes it easier for the founders or their teams to actually be able to perpetuate these cases.
So you've got something there about the moral hazard and the agent principal misalignment between founder, board, investors. And then at the same time, then Vijay, you talked about the fraud cycles earlier. Do you think these have changed? Has fraud become much more sophisticated as you see them through the cycles in your career?
Sure. I think fraud like technology is always sometimes staying ahead of the regulators, ahead of investors, ahead of the enforcers, whoever you want to call. And there's always been this tendency to exploit loopholes. There's always been this tendency to exploit systemic governance issues. So very often what tends to happen is that when you're investing, and I don't necessarily blame the investors for this, because when you're in a private company, I have seen it, especially in a market like India, where a lot of the databases are not online. So there's no way to really verify. If somebody says that they've done this and done that in their past, more often than not, you take that at face value. Yes, you do some basic diligence by asking around to see if there are any, filed cases in court or any criminal complaints and stuff. But there are no real red flags that you can really pop up early. That's one.
Or it's easier to cover them up.
Easier to cover them
before
up.
they become red flags.
Indeed, indeed. And the second part of it is that, like Nick said, very often the frauds get actually blown out of proportion only because they are not stemmed right at the beginning. So I'm a big believer in having processes that kind of can bring up these red flags. So, for example, every deal that's done, as a law firm, we are advising investors on the due diligence, on the negotiation of documents, structuring, and so on, and of course the final docs. But all this happens when you're putting in the money, and understandably, you don't know the company.
You don't run the company.
You don't run the company, and you're an outsider.
Yes.
And yes, so you do need to do the diligence, and that happens. But very often I recommend to our clients, and it's not taken up most times, is even post-deal, at some periodicity, it doesn't have to be every quarter or something, but at some periodicity, you need to have some legal audits as well. There is a financial audit happening every year by law. The accounts are audited anyway. But you could stem some of the red flags and preempt some of these red flags if you had a legal audit, say, twice a year. And that nobody thinks they need, because they're saying, hey, we are now in the company. We are supposed to understand everything that happens. But what they don't understand is very often in the pace to grow and to impress the investors, founders take shortcuts.
And if you look at what's happened, let's just point out that these are blue chip investors most of the time. I mean, I know most of these guys, they're great. They're really good people on the investor side, right? But it's just that it's...
Catch-22?
It is. I don't know if it's a catch-22, but also, none of them knew about it, obviously, right?
I mean, like you said earlier, right? Like if you don't get into the hot deals, you get blamed for it.
Exactly.
You get into the hot deals and you don't do enough. Later on, when it explodes, you get blamed for it. True. So between a rock and a hard place, where do you want to land as both an investor on the other side, resisting the FOMO, and on the other side as an entrepreneur, dealing with the desire to win, which is what drives entrepreneurs, I think, to take crazy risks to do these things and have such low risk success rates in the first place, and yet to not be one of the dead bodies out there that line everyone else's path for success.
Absolutely.
Exactly.
So in that sense, the pressure is real, the moral hazard risks are real, and when you have then state investors investing, state-linked banks lending to these companies, and then having the implosion that happens afterwards. Not everyone understands the investment risks that are associated with putting money behind such high growth, high risk companies. What are your thoughts about public funds coming into these things, the spillover effects? What are your thoughts about it, Vijay and Nick?
When public funds come into the picture, I think they operate under a lot of scrutiny. And what I have found in my conversations with some of them is that they already have a system which is, it's a bit of a paradox. On the one hand, they have all these systems and processes that are necessary because they are a public fund. And on the other hand, on the market side of things, on the deal side of things, the founder community sometimes perceives them as slow and non-responsive. So when you're negotiating with, say, an IFC, I'll just pick a name there, because IFC's standards are up there.
Yes.
They are extremely rigorous, they are very clear what they want. Their documentation is very sound. But at the same time, a lot of founders feel that if they bring IFC to the table, for example, there is a price you pay in a nice way, but it does affect the deal pace, for example. things will take more time. But some founders see the value in it and say, if I manage to get IFC on the table, on the cap table, then that makes me instantly look like a very credible company. So I think all these are a balance of factors that these public funds need to strike. They are investing just like anybody else, but their LPs are much more demanding in my view, and rightfully so, because it's public money of a country. So they are bound to be a lot more sensitive to such risks. But equally, as the funds grow, there is competition within the teams. I mean, it's like a corporate setup anyway, right? So it is bound to happen at some level. But I do think that they need to be playing this game a lot more carefully, and they do for that reason.
I think when acting as an entrepreneur, you have to approach the cap table construction very carefully.
Absolutely.
Beggars can't be choosers. Yet at the same time, when you bring a particular variant or flavor of capital on board, the onus is on always the receiving party, I think, to put in the right practices and the right values and principles to continue to enforce. When you've got public money on your book, you have to be a lot more principled and even put yourself to more regulations, subject yourself to more processes. Yeah. From that perspective, what have you seen? What are some of the examples of good and bad examples that you've seen on this regard? Thoughts about the same topic about public funds and the reputational spillover effects. What are your thoughts?
For me, listen, it should be part of the sovereign fund strategy, right? If their strategy is to create alpha and is to be in privates and they'll have a huge part in publics like everybody else, they should be there. But indeed, their responsibility is in a way higher. And so I feel that two things. One is we haven't spoken about service providers, but they've also had a big part to play in this because Baiju has been diligenced every year for the last 7 years. Full audits, full everything. And, I don't know if people aren't really, now it's two things, right? One, the company is not really providing enough information, but two, are we really asking all of the hard questions and just saying, okay, we'll let it go, right? And so I don't think we should exclude when we're talking about the founders, the investors. There's also service providers, less on the legal side because generally the fraud's not on the legal side, but on the financial side, on the tax side, that's, they have a role to play at least, right? So they should learn from what's been happening. So I think that's an important part.
That's a very good point, Nick, and sorry to interrupt, but I just wanted to add that I will take responsibility for the legal ecosystem as well. The advisor ecosystem or the advisor group has its own pressures as well because our clients are always telling us, you guys are being not very
too fastidious.
Yeah, you guys are being painful. You guys are not being commercial. Again, there is no right or wrong about this. The clients have their own perspective, but I'm a firm believer in this. And in my firm, Lexygen, in our training sessions, we reiterate this day in and day out that our job is to represent the client and the client's best interests. And sometimes the client may not like what we are telling them, but we still need to tell them that. If something is not pleasant but important, we should have the ability to tell our clients that. And the clients, I think, need to be able to understand that you're paying us good money not to do a shoddy job. You're paying us good money to give you good advice. So when we are giving you that advice, listen to us. But many times it becomes very hard. So it's again a sort of
best effort basis.
Yeah, correct.
Yeah. No, but to come back, I think to sovereign funds and kind of more larger investors. One is I think it's crazy how they still suffer FOMO. So they still want to get after all the rounds, and they know that there's not many people who can write 100, 200, 300, right? So I mean, it gets smaller and smaller, that universe, and so they should take their time. Yeah, because it's funny how sometimes a deal can take 6 to 9 months for them to do, and then some deals they'll do in 2 months. What happened here, right? Because you sense that urgency, right? And we've seen it on the crypto side, not to mention anything.
That's even quicker. That's even quicker than pump and dump, yeah?
Okay. But what you'd be surprised, though, is how even I always call basic hygiene in a company, right? That's how I talk about to my founders. I say, hey, basic hygiene for me is you have regular boards where you send a clear agenda, where you send the pack a week in advance, and reporting is clear, and we have an audit committee, and we have an internal auditor that reports to someone who's external and independent and who's not part of the management team, and we have a remuneration committee, and we change auditors every 3 to 4 years, right? That's for me is like, and then of course there's a few other things, but that's basic hygiene. Now you'd be amazed by how many companies don't have any of these. And how for larger investors, even for me, sovereign, this should be a condition. I will not invest unless you set this up.
Yep.
But you'd be amazed by how many times we're pushing for this, and we're one of the lone voices at the board. And then, A, it's easier for the founder to say, hey man, you're just being a pain because we're the only ones doing it. But two, as a fund, every fund in the world wants to be perceived as founder friendly, right? Otherwise, am I going to be getting into the next deal if I'm pushing so hard that I'm really annoying this founder that he's going to talk to the next founder and say, oh my God, these guys just don't get them because they're just such a pain once they come on board. It's process, it's the admin, it's like all of this. Whereas you have to keep pushing. And that's a little bit the duality I find that is hard, is because you have to keep pushing and explain that you're doing it for the good of the company and for actually the long-term interest of the founder, because the earlier he does this, the better it is for everyone. Because then, and I think that's where there's a little bit of duality sometimes.
I think it's normal to have founder friendliness approach towards, especially when you're pre-revenue, when you're still working on product market fit and you're still working on improving on metrics to a point where you're net unit cost positive. When you switch into your B raises and beyond, when you enter significant capital scale, that's when those governance gets extra important. If I'm an investor, I would hope and expect as a green signal that my founders are sensitive to this fact, that when you broach the conversation, that they respond correctly. And achieving this balance is, I guess, what the ecosystem should move towards in the long run. That's going to be tricky, especially when you have confidence of investors, be it at the fund of funds level, be it at the micro citizen level, worried about what's happening to the retirement funds, and having the startup entrepreneurs that are doing much more complex businesses or having they don't raise as much money. That feelings of inequity or inequality that comes about as a result of seeing such fraud they get celebrated as heroes and then they dump. Where does that go? How does that hit us in the ecosystem in the short run, in the mid run? I mean, we've seen multiple cycles of it. FTX, we've seen other such 6 cases. I'm curious to look at it from the perspective of examples of the spillover effects. If you have specific example stories, how have you seen the investor confidence react, restore, without necessarily naming names, but exploring this topic as the final point to touch on this half of the podcast before we shift gears into the second half.
So I think that's a very interesting and important point that you raise, James, is about how there's a lot of build-up of certain founders and then a dump, right? So the whole pump and dump culture, actually, I say it comes from the media, right? I mean, they started it in sport, they have it in politics, they have it in...
Raise this much money, you raise that much money.
It's the same thing. Now, entrepreneurs and founders are the new celebrities. They are the new glam stars.
Shark Tank.
So
I blame Shark Tank.
Everybody wants to be either a shark or they want to be one of the celebrated founders.
Yes.
And that's fine. There's nothing wrong in that, because if you don't glorify to some extent,
that's
why
fine
would
if you're
anybody
discerning.
do it?
That's fine if you're a discerning
Absolutely.
viewer. Yeah.
That is why you need to do that. But at the same time, in today's social media age, this pump and dump is a little bit on steroids. So everything happens very fast. You don't really need the media to pump you up for a period.
They look for the pump.
They look for it.
Or rather, they generate the pump because they need the news.
They need the news.
Yeah.
And then suddenly somebody else has decided. So that's the beauty of social media, is it's not always in your control. And very often the script just goes awry because somebody else has taken control of the narrative. Founders who were once very passionate about their businesses, and that's what made them succeed and raise money from marquee investors, they suddenly start getting more focused on the image, right? The image becomes more important than
legacy story building.
Legacy story building, which is fine. But first build the story, provide the exit,
Deliver
and
the
then
story.
become God. Don't try to become God before you've delivered an exit. That's what I believe.
God.
Yeah. At the fundamental level, I think it's a cultural thing. I think both investors and entrepreneurs need to kind of look a little inward, and the advisor community too. We also tend to focus on some clients more, and it is a natural progression which we all need to look inward a little bit and address.
I think as well, just to add to that, what we should not forget as the local ecosystem. So the biggest issue of all of this is that all of these cases make headlines across the world, right? If you're in Europe, you would have heard of Byju's, you would have heard of eFisheries, you would have heard of Zilingo, if only because some European investors were in there, right? So all of a sudden it's a huge hit in the press, same thing in the US. And the issue that we're to some extent facing, especially in Southeast Asia, less in India, but is that there's a bit of a dearth of growth capital. If you look at it, there's so many VC funds with continuation vehicles, right? There's quite a lot.
Opportunity
funds. Now, continuation vehicles, but then you go up to that next level. How many can write $50 to $100 million checks?
Many.
The list drops down quite fast, right? And then the issue is that you are counting on large other sovereigns or external investors, right? And all of a sudden, the perception of risk will change dramatically because perception of risk is going to Southeast Asia or India. It's high growth, but it's probably a little bit like more legislation is different and not as good. There's a bit of a political risk maybe in some whatever, right? But then all of a sudden, if you add this layer on top, the issue is then that you're actually having less and less people who are considering then investing in Southeast Asia, and that actually for the good founders, it gets harder and harder. And so I think that's where we've got to be cautious because, hey, the funds that are based here are going to continue investing here, right? We're going to try and learn from what has happened, of course, and we're going to make sure that we minimize those cases going forward. But the issue is that founders are going to suffer, and also the other funds in the region, because we need those sovereign funds, we need those guys, and they're under extra pressure, of course, having seen what's been happening, and that's the issue.
Their portfolio returns cannot take that much fraud relative to the IRRs and timeframes that they need to deliver it on relative to the early stage deals.
Exactly.
You can get the 10x among a wider portfolio that you're balancing. Really,
it's a very different, right? In a VC portfolio, you do 25 investments, 5 are going to give you the whole fund, 20 will probably not survive and not do great. Here, you can't have any zeros because the expected return on any deal is maybe 20%.
You'd rather get 2x over 3 years than to get 10x promise on nothing. Yeah?
Exactly.
Yeah. So that's really rough. But as we think about how we as an ecosystem, we at TIE, we at our own capacities, wearing different hats, how can we emerge stronger from this process?
Sure.
What are your thoughts, Nick and Vijay?
And I'd love to hear your thoughts about on the founder side because I think
I'm happy to change role as a
I think
moderator
I think it'd be really interesting, and we have our thoughts around that. But maybe let me start with what we can do as investors. I think indeed the earlier investors start saying to founders that basic hygiene is non-negotiable and that it is in the documentation that there will be an audit committee, remuneration committee, and whatnot. I think that would be a good first step. It just adds a layer of transparency, right? I think the second thing is doing regular exit interviews. I find that that's something that nobody does, but should be part of a diligence and should be part of an ongoing thing, whereas anyone who is an N-2 or N-3 where it's an unwanted exit, someone from the board should go and speak to them. And that should be a basic practice because that's actually, it's always whistleblowers, right? If you look at most of the cases, it was whistleblowers, right?
Yes.
Another thing is that it's forensics, right? You have people that do it and it's very different than what is done in a traditional financial diligence, but it's actually going and see cash accounting, talking to vendors, meeting all the key customers to make sure that they exist and there's no side dealings going on, right? Because that's generally what's happened, right? And then also looking as part of this forensic as to what are the directorships and ownerships of all of the executives in any other company. And are these companies in any way linked to what's happening in our company, right? Because a lot of times there's this kind of round tripping that happens, and that's, it could be family members or whatnot. So I think for me, that's something which has to become in a way common practice. But I think so it's pre-investment, if I can say, where as an investor coming in, you should probably look at a number of things. We also do, for example, founders psychometric assessments. It's one data point, but it does give you a sense of a different lens, right?
Combinations.
We do it on all of our deals. We're one of the only ones to do it. And the founder gets a lot out of it, to be honest, because what we do is he gets a psychometric assessment, numerical and verbal reasoning, a 2-3 hour interview with the person who's doing the assessment. He will get exactly the same report and the 2 hour free coaching. And so basically for us, it's a way of identifying potential gaps. Is he more visionary and he's not an execution guy? So, is the COO good enough? But at the same time, it's kind of trying to see what are his drivers, what are his true motivations. Now, it's never perfect, but it does give you a few additional points, which you can add then to the others, right? Because it's never black and white, right? So there's always a little bit of gray. But I think the more data points you can get, the more comfort you can then take into that investment. And then on the other side, as I was saying, it's post-investment. I think that, every investor has two hats and it's not an easy role to play. You have the investor hat and you have the board hat. Now, each come with fiduciary duties, which are slightly different, often aligned, but you always have to have the cap of the board member who should be doing his role as a board member to strengthen governance, to strengthen processes, to strengthen internal audits, to make sure that you're minimizing any risk of anything happening.
I actually have to say I don't see that being exercised discernibly and regularly enough in this
very
part of the
fair
world.
point.
The sophistication of boards in Southeast Asia is quite wanting at the startup stage, especially up until C round or later, right? I don't see enough of that. Yeah.
I fully agree, and you know, it starts from
the top, right?
It starts from the top.
Yeah.
It starts from the board members, but it starts also from the founders, where generally the quality of what they send to the board is also a little bit, you know, ad hoc.
The training to founders on what it means to have boards.
Yeah.
The training to board members on what it means to be true board members. I feel like that's something that Thai could even explore.
And also for founders to understand that a board should bring something constructive and positive, but not necessarily negative. Whereas for a lot of founders, they see the board as just an obligation. And so they want to minimize anything they can do about it. Whereas actually, if it's used in the right way, and the board members are playing their right role, and not just saying, hey, go fundraise, because we need to mark up, that's the balance that has to be found.
It's tough though.
Yeah.
What are your thoughts, Vijay?
I would agree with most of the points that he made, which basically scream out the message that investors need to demand. They actually have a lot of rights under the documents, most documents. It ends up happening that they have those rights, but they don't really use them till something starts going wrong or starts smelling wrong. And maybe by then it's too late because things have already been going south for a while, and the founder's not been very transparent. So the best way, I think, is to kind of keep the founder honest from day one, is to keep asking the right questions very often. And these questions need to be asked by all the investors. I agree with that too, because if they otherwise what ends up happening is the boards can become a little polarized, and that's never healthy for the company, where there is some perception that investors A and B are with the founder and investors C, D, and E are against the founder. That kind of a thing is never good for the company. I've seen when companies head in that direction, they usually end up in dispute, or the business starts suffering because everyone's disaligned fundamentally. But having said all that, speaking from the prism of a legal advisor, I would say that advisors need to stand up and do their bit too, for the ecosystem. Very often, what ends up happening, and I see this a lot in early stage deals, is that there is a huge budgetary constraint in early stage deals. So what ends up happening is the scope of the diligence gets reduced. So and the advisory firms very often start saying, okay, we'll do it for lesser. There's a lot of competition. We'll do it for lesser. But I'm a believer in this, that when somebody says, I will do it for half of what it should cost me, but I'll give you a full 1x of value, that is BS. Okay, that's
it. Never happens. To get monkey.
Yeah. So I always say that the ecosystem should not incentivize bad behavior at any level, including at advisor level. Advisors should be encouraged to have honest approach. Sorry.
So on that point, I want to bring something up that struck me as you guys were chatting about this topic. We're in Asia. We don't have as open a handling of failure. We're not willing to discuss failure. We're not willing to consider learning collectively through everyone else's failures. Like the media celebrates much more about successes. We talked about that earlier.
Of course.
The service providers don't want their names mentioned if they're associated with those failures along the way, rubber stamped or not otherwise. Investors want to scrub parts of history over time if they can, or blame investment teams for making the wrong calls on those specific bad investments. How can we then emerge stronger? Because, has the cycles shown us that this can get better, truly? Has it gotten better? Yeah. Can it get better over the different cycles?
So that, it's not like you act like it doesn't exist. You have to recognize that the dark side exists, and you have to make the right processes to ensure that the dark side cannot succeed. And that's what it's all about. And words like dark side maybe take on a very moralistic tinge to it, but even if you look at it in a simple scientific way, if you have processes to check conduct that is undesirable, you will ensure that there is lesser instances of that kind of stuff happening, right? And if I were to draw a parallel from criminology and policing and all that, the broken window theory. So basically, in a neighborhood, if you see a broken window and you just let it be, there are going to be more broken windows. There's going to be crime. There is going to be muggings. There's going to be all sorts of things happening over time. The first broken window needs to be fixed immediately. So it's the same with, I think, startup hygiene, investing hygiene. I think all ends of the ecosystem need to work constantly to clean up. And I think every now and then these kind of things happening are also necessary, in my view, because it's like a wake-up call. When we start getting smug that everything's great about our economic cycle, something like this happens, and then you are like, okay, we need to, unlearn some of the old lessons and, relearn some of the new ones.
We're in a very data-driven world today.
Yeah.
My view, if you look at, say, the value of intellectual property, I mean, in financial world, it's very obvious. Assets, liabilities need to stay on the books.
Yeah.
Yet, it took a while before intellectual property, intangibles, were added to the mix.
Absolutely.
Then we talk about culture, we talk about people. But yet those things don't show up in the books. I feel like as we at the bottom of the pyramid push at this at ecosystem level, you also need the top. People at the boards, people at the LP decision makers, the funders of the fund of funds, the funders of funds, to really start relooking this. You have sustainability climate reports. There should be what I call the PPP, right? The public-private partnerships, the non-profit participatory efforts to put in place such advocate and push in place and train more transparency on the self-reporting of what these things should be. Hopefully then over more cycles, it stays transparent.
Yeah.
Right? This networked world, data-driven world can then come about with hopefully more permanent structural change to this weird game theory that's been repeating itself over and over again in different forms. Otherwise, you can't check and balance. The one arm of the muscle doesn't grow as strong as the other side of it for you to extend without breaking your arm, right? Literally. Yeah. So that I think I would love to see a lot more of.
Absolutely.
Yeah.
There's a lot of negative news that has come out, of course, about these cases. But on the other side, there's some great companies out there still and some great founders who are not doing this, right? If you look at the list of investors, and again, these are all blue chips investors between Baiju's, Lingo, and the latest one in Indo. If you look at the list of those investors, these are all guys who are going to go through a very strong internal discussion of what are we going to do to not let this happen again. Trust me, they're going to have these discussions, right? And they are having them. And so I do feel that it is getting slightly easier over the last 2 years to start asking for all of these rights and just saying, we're not doing a deal if it doesn't come in. And I think that you're going to see that come more and more to the front. And so I think that's a change that I'm hoping to see, at least from investors and at board as well, right? I think now that these discussions, it's happening, right? And so it's no longer, but it hasn't happened. There's been a number of cases, why don't we have this in place, right? And this is not only for the good of the existing investors, this is for the company so that it can raise easier in the next round, because it will have an impact as how the next guys will look at it, right? And so I think that's something where I do feel that, talking about it, even if we all agree about what needs to be done, is important, because then people will start asking for it on a more frequent basis.
Yeah.
I'll just add to what Nick said. What I would like to see from both the investor and founder community, because I'm an advisor. I'm not the one who makes those calls, but what we always say to our clients, irrespective of who we are acting for, is don't try to over-optimize when you're negotiating your documents. Very often, if you put clauses that the other party is not really happy about, but is agreeing to because they don't have a choice, they're going to try to
get around
screw you over. While I'm not saying that justifies any bad conduct, fraud is never justified, but there is an explanation for it. There is a set of facts leading up to it. I usually think that when parties are reasonable with each other in what they agree on, there is generally a tendency to not look for ways to correct.
Yeah.
And it works both ways. What happens with early stage, where the investor holds the upper hand and says 4x liquidation preference, the similar thing happens with the founders. When they have raised Series D, Series Z, they start acting like, I'm giving you 15 days to fund this, take it or leave it. So,
and I think that, sorry to interrupt you, but you just brought up something in my mind is that the issue is that a lot of people say it's for the next round for people to do this. And so you come into a Series C and you look at the docs, there's nothing around fraud. There's nothing around any of these things. And so people are always saying the next guy will put it in.
Yeah.
Actually, it should be in from a Series A.
Yes.
You know, why would it not be there?
Just they found investing.
And not
from the
just,
earliest
it's for the
rounds
growth
possible.
investors to come in, because then the growth investor comes in and he's asking for such a huge add-on that the founder will say, hey, I'm not going to take this guy, I'll take the easier route. You know what I mean? That's something that we've seen a lot where we look at like, you know, Series C docs and we're like, whoa, I mean, there's nothing in here, right? Around basic stuff, around fraud, about clawbacks, and so I think that's something where
I agree
it should
with
start
that.
easier.
Yeah.
So if I were to
Anybody
summarize-
who's institutional funding should start saying that, you know, they need it because they're an institutional fund.
So I'm a very spiritual, not religious person.
Mm-hmm.
I like cyclical religions more than I gravitate towards than linear ones.
Okay.
I'm hearing cycles. In summary, yeah,
Mhm.
I'm hearing cycles. I'm hearing that the buck stops with us, that we start doing it in our own worlds,
Yep.
hats, regardless of which side of the triangle we sit on. I'm hearing that we look inwards.
Yeah.
That we have to ask ourselves, what role can we play, should we play as we participate in this thriving, hopefully virtuously cycling upwards ecosystem that doesn't get too bogged down by these fraud cases.
Sure.
So with all these coming together, I would like, I have to thank the two of you gentlemen joining me on today's panel. I want to thank you for your views. I want to thank you, Nick and Vijay, and call this podcast to an end.
Thank you as well, James, for sharing your perspectives as well based on your experiences as founder. So I think we had a very interesting discussion presenting three different but important perspectives. And thank you to Ty for having us here.
Yes.
No, thanks, James. It's
Any
been a
closing words?
pleasure. Super interesting. Lots of, you know, different thoughts and views shared. And I think, you know, another thing that I may add to what you very well summarized is that never take the easy road.
No. The
And
funny
as an
thing is-
investor, as an advisor, as a
Yes.
founder,
Oh, I like that. Yeah.
the easy road always leads to the first step
Yep.
that will lead to the second step, that will
Yes.
lead to the third step. And so-
Unfortunately, you know, we're given choice as human beings,
Yeah.
and exercise choice.
Yeah.
Never take the easy way out.
Yeah.
On that note, thank you, gentlemen.
Thank you so much.
Thank you,
Ty.
thank you, everybody.
Yeah.